Joining us now in a CNBC exclusive is Steven Mnuchin. He's the former U.S. Treasury Secretary, founder of the lead investor behind the capital infusion, Liberty Strategic. Mr. Secretary, great to have you this morning. You decided to put as much as I think it's 15% of the capital in your fund into NYCB. And I guess I have to wonder why, when only a week ago management identified material weaknesses in the company's internal controls related to internal loan review. And analysts will still point out that the business model is still very much overweight some of the least desirable parts of the commercial real estate market. So why is this a good investment?
Well, first of all, it's great to be with all of you here today. This is a business I've known well for a long period of time. So we looked at a long time ago potentially merging One West with New York Community, so I've been following it. And more recently, when they did the Signature Bank deal last year, I followed it as well, which I think was a very attractive deal for the company, and particularly bringing the two franchises together. So at the end of January, the company announced some issues associated with cutting the dividend and increasing reserves. I reached out to the company and began a diligence process in case they wanted to increase capital. And it was really at the end of last week that we moved forward very quickly. So I like the franchise a lot. It's a top 20 bank in the U.S. with very attractive markets. It's got a great branch network. Unlike the banks that had problems last year, this business has 80% of their deposits are insured, so it's got a very stable deposit base. And the issue is really around perceived risks in the loans. And with putting $1 billion of capital into the balance sheet, it really strengthens the franchise. And whatever issues there are in the loans, we'll be able to work through. And bringing Joseph Otting in, who I worked with very closely in One West and then as controller, I think there's a great opportunity to turn this into a very attractive regional commercial bank.
And you're confident that they have effectively recognized some of the risk within the portfolio itself? I mean, again, in reference to the fact that they did cite, and we know that there seem to have been material weaknesses in some of their internal controls in terms of reviewing loans. Do they still have a ways to go there? What gives you the confidence that that loan portfolio is as strong, or perhaps as worthy at least, as you seem to indicate?
So let me just say, Sandro, who was the chairman and did the Flagstar deal, when issues came in, Sandro took over as executive chairman and stepped into the CEO role and really did a great job in a short period of time, really on this. And we did extensive diligence on the large loans. The bank will look at the reserves, and we'll make sure over time it has the appropriate reserves. And that can be done through a combination of our capital and earnings. We cut the dividend down to $0.01 a share, so we're going to retain almost all of our earnings. And we think the asset side is very manageable. The bank has today about 11% Tier 1 capital, about 10% CET1. And if we need to take more reserves in the future, which we'll carefully review, we clearly have the capital base to sustain that.
All right, Mr. Mnuchin, it's great to have you on. Thank you. I do want to go over some of the portfolio issues. 1/5 of these loans are tied to New York rent-regulated multifamily. That law changed dramatically since many of these apartments were lent to. You do have a lot of criticized loans, including $552 million, potential loan losses involving a co-op, involving office space. What makes you think, in light of the fact that this company, I will willing to say, was offering some suboptimal financials, that you really have a handle on how bad this bank is?
Well, let me just say, I think that co-op loan was really a one-off situation. And I think they've either sold it or they have it committed to sold. I don't know if it's closed yet, but that was really a one-off situation. Look, we understand what's happened in the rent-stabilized market. There were a lot of people who bought these properties with the idea that they could convert them and raise rents, and they're not going to be able to. But there's a lot of people in this portfolio that didn't. A relatively small part of the portfolio are large loans with 100% rent stabilization. When the bank made these loans, they were very low LTVs, so I think there's a lot of cushion in it. The good thing is, look, I think interest rates are going to come down over the next 2 years. The great thing about multifamily is, unlike office, they have cash flow. With lower interest rates, that's going to help a lot. And there clearly will be some problems in the portfolio. There's no question about that. And we've taken that into our account in the underwriting. And that's why we raised $1 billion of capital. So, any issues the bank has with needing additional reserves and problems, we'll be able to deal with.
Okay, so Mr. Secretary, we know that some of the loans had already been previously Signature sold. They had a hard time getting 70 cents to the dollar for a lot of these loans, again, because of these 2019 law changes. And we know that there are, starting in 2025, a lot of what I can just say that have to be some sort of refinancing. Are you taking that all into account and feeling confident that maybe the value of real estate's better, or that maybe the 2019 law will not be as prohibitive for the rest of the properties?
I'm not taking into account there's any changes in the law. So we understand the law and the impact. Let me say the bank was very smart. When they did the Signature deal, which was an assisted deal, they left the bad loans with the government. So you can assume those were the worst loans. And they were sold at distressed prices to, real estate funds. So, I think that was a great transaction. When they did it, they got cash. They didn't take any of the bad loans. And look, we're going to work through these loans over time. I would just put this in perspective. And again, these are approximate numbers. But when we did the deal yesterday, I think the tangible book value was about $6.65 a share. Based upon the closing price last night and the warrants, tangible book is still $6.20 a share. And, the stock is trading at a significant discount to that. So, look, Joseph and I have done this before with a bank that needs to be rebuilt. We're going to retain earnings. We're going to build reserves when we need to do that. And, we got plenty of time over the next couple of years to really rebuild this franchise. And look,
Wow, what an eye-opening interview with Steven Mnuchin, the former U.S. Treasury Secretary and founder of Liberty Strategic Capital. His decision to invest a staggering $1 billion in New York Community Bancorp, or NYCB for short, has sent shockwaves through the financial world. But is this a brilliant move or a risky gamble? Thank you for tuning in to InvestMinder, your go-to source for insightful investment analyses and thought-provoking discussions. If you haven't already, make sure to subscribe and hit the notification bell to stay up to date with our latest videos. Disclaimer. Please note that InvestMinder is not a professional financial advisory firm, and our content is intended solely for educational and entertainment purposes. Always consult with qualified professionals before making any investment decisions. Now let's dive into the details of Mnuchin's bold bet on NYCB and explore the potential risks and rewards involved in this audacious move. Steven Mnuchin's decision to pump $1 billion into New York Community Bancorp through his investment firm, Liberty Strategic Capital, has undoubtedly sparked intense debate and speculation within the financial community. On one hand, NYCB is a well-established regional bank, with a solid presence in attractive markets and a strong branch network. However, on the other hand, the bank has recently faced significant challenges, including identifying material weaknesses in its internal controls related to loan review processes and an overexposure to segments of the commercial real estate market that have been deemed less desirable. During the CNBC interview, Mnuchin highlighted several compelling reasons behind his investment in NYCB. Firstly, he emphasized his familiarity with the bank, having previously considered a potential merger between One West Bank, where he served as chairman, and NYCB. Additionally, Mnuchin praised NYCB's acquisition of Signature Bank's assets last year, describing it as a very attractive deal that brought together two strong franchises. Mnuchin also pointed out that unlike the banks that faced troubles last year, NYCB boasts a stable deposit base, with 80% of its deposits being insured. This stability, combined with the infusion of $1 billion in capital, is expected to provide NYCB with the necessary resources to navigate through any potential issues within its loan portfolio. Furthermore, Mnuchin expressed confidence in the bank's ability to manage the perceived risks associated with its loan exposure. He cited the extensive due diligence conducted on the bank's large loans and the plan to retain almost all earnings by cutting the dividend to a penny per share. This retained capital, combined with the $1 billion investment, will allow NYCB to bolster its reserves and address any potential loan losses effectively. NYCB's loan portfolio is not without its challenges. A significant portion of the bank's loans is tied to New York rent-regulated multifamily properties, a sector that has been impacted by regulatory changes in 2019. These changes have made it more difficult for property owners to raise rents, potentially affecting the value and cash flow of these properties. Additionally, NYCB has a sizable portfolio of criticized loans, including a $552 million potential loan loss involving a co-op and law firm space. Despite the challenges facing NYCB's loan portfolio, Mnuchin remains optimistic about the bank's prospects. One of the key points Mnuchin emphasized was the low loan-to-value (LTV) ratios at the time these loans were originated. Additionally, Mnuchin expressed his belief that interest rates will likely decline over the next 2 years. Another factor that could work in NYCB's favor is the bank's strategic decision during the Signature Bank acquisition. Moreover, Mnuchin underscored the significant discount at which NYCB stock is currently trading compared to its tangible book value. Furthermore, the success of Mnuchin's investment will heavily depend on the bank's ability to effectively manage its loan portfolio and address the material weaknesses in its internal controls. The strengthening of NYCB's leadership team, with the addition of Joseph Otting as the controller, could prove instrumental in implementing robust risk management practices and enhancing oversight mechanisms. Nonetheless, it's essential to acknowledge that even with the best leadership and strategies in place, the road to recovery may be long and arduous. Rebuilding trust among investors, regulators, and the broader financial community will require transparency, accountability, and a demonstrable track record of improved performance. As NYCB embarks on this transformative journey, it will be closely watched by industry analysts, investors, and regulatory bodies. Any missteps or further revelations of mismanagement could potentially erode confidence and undermine the bank's efforts to regain its footing. Conversely, a successful turnaround could position NYCB as a compelling investment opportunity and a testament to the power of strategic leadership and capital infusion. Ultimately, the verdict on Mnuchin's bold bet will be determined by NYCB's ability to navigate the challenges, capitalize on opportunities, and deliver sustained financial performance over the long term. Whether this investment proves to be a stroke of genius or a costly gamble remains to be seen, but the implications for the banking industry and the broader financial landscape cannot be understated. As we come to the end of our in-depth analysis of Steven Mnuchin's audacious investment in New York Community Bancorp, one thing becomes abundantly clear. This move has the potential to reshape the landscape of regional banking, setting a precedent for how strategic capital infusions and leadership changes can breathe new life into troubled institutions. While the risks associated with NYCB's loan portfolio and internal control weaknesses cannot be ignored, Mnuchin's unwavering confidence and the bank's strong market presence suggest that this gamble could pay off handsomely if executed correctly. However, success is by no means guaranteed, and the road ahead is likely to be paved with challenges and uncertainties. As investors and industry watchers closely monitor NYCB's progress, several key factors will be under the microscope. The effectiveness of the new leadership team, led by Joseph Otting, in implementing robust risk management practices and addressing the material weaknesses will be paramount. Additionally, the bank's ability to navigate the complexities of its loan portfolio, particularly its exposure to the rent-regulated multifamily sector, will be a critical test of its resilience. Furthermore, the broader economic environment, including the trajectory of interest rates and the health of the commercial real estate market, will play a significant role in shaping NYCB's fortunes. A favorable interest rate environment could provide much-needed relief for borrowers, while a prolonged period of high rates or deteriorating market conditions could exacerbate the bank's challenges. Regardless of the outcome, Mnuchin's bold move has ignited a firestorm of debate and speculation within the financial community. Critics argue that his motivations are driven by personal gain, while supporters laud his willingness to take calculated risks and his track record of turning around troubled institutions. Only time will tell which side of the argument prevails. As we bid farewell to this intriguing saga, one thing is certain. The implications of Mnuchin's investment in NYCB extend far beyond the bank itself. This move has the potential to set a precedent for how strategic capital infusions and leadership changes can revive struggling financial institutions, offering a glimmer of hope for those mired in challenging circumstances. Thank you for joining us on this captivating journey through the world of high-stakes investments and regional banking. If you found this analysis insightful, be sure to like, share, and subscribe to InvestMinder for more thought-provoking content. Until next time, happy investing! As of the interview, the tangible book value was estimated to be around $6.65 per share, while the stock was trading at a considerable discount, even after factoring in the warrants issued as part of the investment. This discrepancy suggests that the market may be undervaluing NYCB's assets, presenting a potential opportunity for patient investors. However, it's essential to acknowledge that Mnuchin's optimism may be influenced by his personal involvement and vested interest in the bank's success. As the lead investor and a seasoned financial executive, he has a stake in ensuring that his investment pays off. Therefore, his assessment of NYCB's risks and potential rewards should be scrutinized objectively by analysts and investors alike. Furthermore, while Mnuchin's track record and experience in the financial sector are undoubtedly impressive, his involvement does not guarantee a positive outcome for NYCB. The bank's turnaround will ultimately depend on its ability to navigate the challenges within its loan portfolio effectively and capitalize on the potential opportunities presented by the changing interest rate environment and market dynamics. One of the key strategies outlined by Mnuchin during the CNBC interview is the plan to strengthen NYCB's leadership team by bringing in Joseph Otting as the bank's controller. Otting previously worked closely with Mnuchin at OneWest Bank, where he served as the chief executive officer. This reunion of familiar faces could prove to be a valuable asset for NYCB as it navigates through its current challenges. Mnuchin's confidence in Otting's capabilities stems from their successful track record of turning around troubled financial institutions. Together, they were able to transform OneWest Bank, which faced significant difficulties during the financial crisis, into a profitable and well-respected regional bank. This experience could provide valuable insights and strategies for addressing the issues facing NYCB's loan portfolio and internal control weaknesses. Moreover, the addition of Otting to NYCB's leadership team could help restore confidence among investors and analysts who have raised concerns about the bank's management and oversight. With a seasoned executive like Otting at the helm, NYCB may be better positioned to implement robust risk management practices, strengthen internal controls, and effectively manage its loan portfolio. However, it's worth noting that Mnuchin's involvement in NYCB has also sparked criticism from some quarters. Detractors argue that his investment may be motivated by personal gain, rather than a genuine commitment to turning around the bank's fortunes. These skeptics point to Mnuchin's involvement in the controversial acquisition of IndyMac Bank during the financial crisis, which was later rebranded as OneWest Bank. Critics argue that OneWest Bank's aggressive foreclosure practices and alleged mistreatment of homeowners during the crisis have tarnished Mnuchin's reputation. While he maintains that the bank followed appropriate procedures, these criticisms have raised questions about his motivations and the potential impact of his investment on NYCB's customers and communities. Regardless of these concerns, Mnuchin remains steadfast in his belief that NYCB represents a compelling investment opportunity. He emphasizes the bank's strong market presence, attractive branch network, and the potential for growth once the current challenges are addressed. Additionally, he highlights the significant discount at which NYCB's stock is currently trading relative to its tangible book value, suggesting that the market may be undervaluing the bank's assets. As the dust settles from Mnuchin's bold move, investors and industry experts will closely monitor NYCB's performance and the effectiveness of the strategies implemented by the new leadership team. The bank's ability to navigate the complexities of its loan portfolio, strengthen internal controls, and capitalize on market opportunities will ultimately determine the success or failure of this high-stakes investment. While Mnuchin's investment in NYCB has garnered significant attention and sparked a lively debate within the financial community, it's crucial to recognize that the bank's turnaround will not be an overnight success. Addressing the challenges posed by the criticized loan portfolio, material weaknesses in internal controls, and exposure to the rent-regulated multifamily sector will require a concerted effort and a long-term strategy. One of the key factors that could play a pivotal role in NYCB's recovery is the broader economic environment, particularly the trajectory of interest rates. Mnuchin expressed his belief that interest rates are likely to decline over the next 2 years, which could provide a much-needed boost to the cash flows of multifamily properties. This, in turn, could alleviate some of the pressure on borrowers and potentially mitigate the risks associated with NYCB's exposure to this sector. However, it's important to note that interest rate projections are subject to various economic factors and uncertainties, and a prolonged period of high interest rates could further exacerbate the bank's challenges. Additionally, the impact of interest rate changes on the broader commercial real estate market could have ripple effects on NYCB's loan portfolio, necessitating a proactive and adaptive risk management strategy.
Hope you found today's analysis helpful as you look for profitable new stock opportunities. This was InvestMinder. Remember, knowledge equals profit in the stock market. Thanks so much for watching, and please hit that thumbs up button if you got value from this video. Make sure you click to subscribe as well to get our next videos when we reveal the best new insider stock purchases. Invest wisely, trade carefully, and we'll see you next time. Disclaimer: InvestMinder is an independent stock market commentary channel for entertainment and basic informational purposes only. We are not licensed financial professionals and do not provide personalized investing or financial advice. P.S. If you stayed watching until here, you are awesome. Thank you for enabling me to keep making these videos with all the likes and subscribes. Have a great day, and we love you all.